something there. Okay.
Okay.
Go ahead, Clyde.
All right, good. So what our topic is today is Social Security taxation. We find that a lot of people that we talk to that come to our workshops, and we've been doing workshops and seminars for many years, and a lot of people don't realize that they're even going to be taxed on their Social Security. They kind of are shocked by the fact that they're going to have to be paying taxes on Social Security. Well, it's much worse than that. It's not only going to be taxed on your Social Security, but the way that you have to pay your Social Security and where the money comes from usually causes the tax to be a lot higher and a lot more impactful on your retirement in a bad way than what you think. So we're going to talk about the real cost of Social Security and what you can do to mitigate that. So what the government does is they look at something called provisional income. A lot of CPAs don't even know what this is, but provisional income is simply the definition of the income that counts towards how they're going to tax your Social Security. In other words, what they count as your income. And then there's certain parameters that determines if you make over X amount, then you pay taxes on this amount of your Social Security. So we're going to go through that real quickly. It's not that difficult to understand, but here are the things that are provisional income. Number one, all your earned income, okay, and everything. All your earned income that shows up on your tax return is part of your provisional income. Also includes distributions from your qualified plans, your IRAs, your 401ks, etc., what we call the tax deferred bucket. We're going to talk about that in a minute. Required minimum distributions when you're 72, you have to start taking those. Those count towards your provisional income. Then all income from the 1099s, any income from what we call the taxable bucket, 1099s, that counts towards your provisional income. Any pension income counts towards your provisional income. All rental income from any income properties you have. Interest from municipal bonds count towards you. A lot of people consider municipal bonds tax-free. Well, the interest from municipal bonds count towards your provisional income, which counts towards your how they calculate your Social Security. And they also throw in there 1/2 of your income from Social Security counts towards your provisional income. So in other words, they are hoping that you will be taxed on your provisional income, and just about every kind of income you can think of counts as provisional income, including half your Social Security. Okay, next slide. Okay, so here are the thresholds. If you're married and you make over $32,000, you're going to pay 50%. So 50% of your Social Security is going to be taxed. If you're a married couple making above $44,000, you're going to be paying taxes on 85% of your Social Security income. If you're single, it's actually a better deal. So if you're single, 25 to 34,000. In other words, if you make over 25,000, you're going to be paying taxes on 50% of your Social Security. And if you make above 34,000, you're going to be paying taxes on 85% of your Social Security. Okay, so let's see how this works for a married couple. We'll take Bob and Mary here, and we'll assume their income is $70,000 from pension income, $30,000 from their RMDs, because they're both over 72 now, and 1/2 of their Social Security is $15,000. So in other words, their Social Security income is $30,000 a year. They're going to be provisional income is going to make you count $15,000 of that. So that's well over the $44,000, as you can see. It's $115,000, and most married couples are going to be above $44,000. So most couples, unless they do what we're going to suggest you do, and we'll show you in a minute, are going to be paying taxes on 85% of Social Security. So Bob and Mary are going to be paying 85%. Their federal marginal tax bracket we'll assume is 24%. Their total Social Security benefit is $30,000. 85% of 30,000 is 25,500. That's what they're going to be paying Social Security. They're going to be paying taxes on. Times 24%, their federal tax is $6,120. That's a big chunk. That's a very big chunk that's now coming out of your savings every year in retirement that you probably didn't think was going to be coming out. Okay, it gets worse. So the impact of Social Security is more than that, because here's what happens. That 6,120 hole in their investments is actually more than that, because what they're going to have to do is they're going to have to take money out of their tax deferred bucket to pay that. What do they have to pay when they take money out of the tax deferred bucket? They have to pay taxes. So to get that 6,120, they're going to have to take out 7,921, pay taxes on the 7,921 to get to the 6,120. So the real cost is 7,921, but it's actually worse than that. Move on. So what did they really lose? What they really lost is not only the 6,120 and the $1,800 of taxes that they had to pay on it, which is 7,921, but they no longer have this money in their investment plan, which they were counting on for the retirement income. In other words, every year, they, instead of having 7,921 growing at 8% over the next 20 years, they don't have that anymore. That opportunity cost is $428,398. We're talking almost $500,000. That's a huge impact. Actually, it's much worse than that, because Social Security goes up with inflation. So the amount that you're actually going to end up paying adjusts every year to keep up with inflation. So the amount is actually more than 428,000. For most people, it's going to average around $500,000 is the actual hole in your investment plan for the entirety of your retirement. So what can we do about this situation that would help? Well, we can ensure that your provisional income stays below the thresholds. And how do we do that? We do that by having most of your money be moved from the taxable bucket to those, from the tax deferred bucket to Roth IRAs, Roth 401ks, Roth conversions, and cash value life insurance. All four of those vehicles where you can have your money will allow your money to grow tax deferred and come out tax free. The single greatest contributor to Social Security taxation is having too much money in what we call the tax deferred bucket. So let's take a look at those three buckets. That's what this is all about here. And that is moving your money so that you can be in a situation where your provisional income is lower. Whoop, where's our bucket slide?
It is not there.
Okay.
Yeah.
Can we get one?
Yeah.
Yeah. Okay. Hold on one second, folks, because this is important.
Let me get one here.
Basically, folks, what it is, okay, here we go. Beautiful. So we have three, but there are thousands of different investments, places you can have your money, but they all fit into one of these three buckets in terms of the IRS. Everything, no matter where your money is, it's going to fit in one of these three buckets. The first bucket is anything that you get a 1099 on, it's in the first bucket. In other words, this is money that you've already paid taxes on. You've already earned this money, paid taxes on it, and now you're investing it. It's money that you want to invest for your future. I look at it as seeds. Every dollar that you have that you made and that you're investing for your future so that when you retire, you have enough money to live on for the rest of your life. It's going to go in either this first bucket or the second bucket or the third bucket. A lot of people have money in this first bucket and probably have too much. We see this all the time. This is your money market accounts, your savings accounts, your CDs. And the problem with those investments is that you don't keep up with inflation, because the return on your money market accounts, savings accounts, CDs is usually less than inflation. And these days, definitely less than inflation, because you're talking about maybe 1 or 2% on these things, and inflation is at 3%. So you're losing money there. But not only that, not only you're losing money to inflation, it's worse than that, because you're being taxed on all the interest that you make in this bucket. So you're going to be getting a 1099 on any interest that you make on any of these investments. So it just doesn't make sense to have much money there. Why would you have any money there at all? The one advantage of money in these things, it is liquid. In other words, you can get your money out. So the only thing that you want to have in there is enough. The only amount of money you want to have in there is enough to keep you from, being able to be in a situation where you don't have liquidity. So it's what we call the emergency fund. And most financial advisors would agree the amount you want to have there is 6 months income. Everything that you have beyond that, you want to be able to shift into what we call the tax-free bucket, which we're going to explain in a minute. So that's the taxable bucket. 1099 income, it's in the taxable bucket. Okay, the next bucket, you're not going to receive any 1099s because this is your tax deferred bucket. These are your IRAs, your 401ks, your 403bs, your SEPs, private corporate plans, and all these kinds of things, which are going to be tax deferred. In other words, everything in this bucket is going to grow tax deferred, but when you take it out, you're going to be taking out at ordinary income rates. You're going to be paying ordinary income tax on every penny you take out, the original principal, as well as all the gains. There are no capital gains exemptions here, nothing like that. It's all 100% ordinary income at whatever rate the government decides it's going to be when you take it out in the future. So that's the tax deferred bucket. Now, there are also lots of restrictions. You can't take it out until you're 59 and a half. You have to take it out when you're 72. They start, the required minimum distributions. So there's a lot of restrictions in this bucket as well. So that's the tax deferred bucket. And we'll come back to that in a minute. But I want to introduce that third bucket, because this is the good news on all this situation. If you want to avoid taxes on Social Security, you want to be able to get as much money into this third bucket as you can. And we'll show you how much you can leave in this middle bucket in just a second. But most of it you're going to want to put from the taxable number one bucket to the tax-free bucket, and the second bucket to the tax-free bucket. So this is Roth IRAs, this is Roth 401ks, and these are Roth conversions. They're also life insurance retirement plans. These are things that the government allows you to have your money grow tax deferred and come out tax-free. Life insurance, cash value life insurance, has had that tax advantage since 1913, since the tax code was in effect. So those are the four things that we like to see our investors put their money in, so that they can have everything go tax deferred and everything, if possible, come out tax free in their retirement. And it makes a huge, huge difference when you do this conversions. We do comparisons for people that show the difference before and after if you make these shifts. Now, the good news in this shifting from the tax deferred bucket to the tax free bucket is it used to be very limited what you could do in a Roth conversion. But now they've changed the rules so that you have no limits to how much you can convert from that second bucket to the third bucket. So a Roth conversion can be a very, very good thing for you. Now, the other thing to point out is we believe very strongly that tax rates are going to be going up. In fact, every economist that we've interviewed and that we've talked to believes that tax rates are going to be going up and going up substantially in the next few years. And it's because of the debt and the amount of debt that we have in this country and that we continue to put on. In fact, in the last few weeks, we've seen trillions of dollars added to the debt. Any economist will tell you that any increase in the debt is in fact a future tax increase. So if taxes are going to be going up in the future, and we believe that when this current tax regime that we have now ends in January 2026, that's when taxes are going to double or triple in terms of what they are now. So in the next 5 or 6 years, it is a golden opportunity to move money from that middle bucket to the third bucket. Because the one downside of making these moves from that middle bucket to the third bucket is you have to pay taxes.
Clyde?
And what we do is over the years, we shift money in a scheduled way where we minimize the amount of taxes that you have to pay. Were we going to say something, Art?
Yeah, Clyde, I was going to say, can you explain how much money we can leave in that tax deferred bucket and still be in the zero tax bracket?
Absolutely. Every one of you has will have a basic deduction. We call it the standard deduction. For a couple, it's about $24,000 a year, and for a single person, it's half that. It's $12,000. So you have that standard deduction. So you can leave enough money in that middle bucket so that when you take your required minimum distributions when you're 72, the standard deduction will cover the taxes on that distribution. So that amount works out to $500,000 for a married couple and $250,000 for a single person. So if you're married, you can leave $500,000 in that bucket and still be tax-free when you retire. If you're tax-free, what we mean by that is you're not going to pay taxes on any of your income because it's going to be coming from a life insurance policy or one of these Roth IRAs, or it's going to be coming from that middle bucket, but it's going to be covered by the standard deduction. And if you're in that situation, which is where we try to get every one of our clients, then you will have no provisional income. So remember what provisional income was. All the income that they use to count towards whether your Social Security gets taxed. If you follow our plan and you make these shifts from the taxable bucket and the tax deferred bucket into the tax-free bucket, you will not pay taxes on any of your income, including Social Security. So this is the solution. Pension income counts as provisional income, as we said. Oh, and now you guys want to talk a little bit about the how you can take your Social Security, which is also a very, very important thing. So I'm going to introduce Len now. We can come back and take questions on what I went over in a few minutes. So Len Strickler, who is a member of the National Social Security Association, he's taken all their courses, is going to tell you a little bit about how the National Social Security Association can help you and helps us help you. Okay, Len.
I appreciate it. Just wanted to let you know, folks, that, Clyde talked to you a little bit about taxation. And the next question is, okay, how do we take Social Security? There are literally over 256 ways to take your Social Security. So the question becomes, do we take it at 62, which we know we can take it at 62? What impact does that have? What is my full retirement age? Most of it, so about 66, about 66 years old. We can start taking our full retirement. Let's say it's $2,000. Well, if you took it early, which you may need to. I mean, you may need the money. There may be a reason to do that. We help you with that. We help you with the timing, when to take it, how to take it. And if you were to do that, of course, the 2,000 would maybe you get 1,500. I'm just using some round numbers for you. But if you were to wait until 70, you're going to get a rate of return, which is not bad, of about 8%. So getting 8% from say 67 for up to your age 70. After 70, folks, doesn't matter. I mean, you're not going to get any more. You might as well take it then. But you may want to look at how you take it. There's things in this, the whole IRS, there's a book that's probably about 5 inches thick. It's very, very complex. But there are ways to take your Social Security. You might want to claim on your spouse. Your spouse may want to claim on you. We call that a restricted application. Still available for those that are 55 and under or born in 1955 or earlier. So there are some ways to take it. Johnny Carson, you remember him, the talk host? Johnny had 4 wives, and all 4 of his wives actually claimed on his Social Security. So there's provisions in here for if you've been divorced. There's provisions in here for if you've been disabled. So there's a lot of different ways, and we have some software we take you through to show you when's the next time to take your Social Security. Now, NSSA, I'm a member or a team with this organization. One of the founders, Jim, has been with Social Security for 37 years. Jim did all the tough cases. So I have access, our team has access to him, both Jim and Mark. Mark's a CPA who's a partner with Jim. But we have access to these folks. Pick up a phone. If you have questions, we can pick up a phone and we get answers. Additionally, we have a help center that we're going to be setting this up. It'll probably be up on our website, hopefully by this weekend, where you'll be able to go to this particular landing page and get a free retirement planning book. And so in this book, there will be things of how to maximize your Social Security. It'll go over all the things I just talked about in greater detail. Are annuities right for you? Maybe that there's some things and some vehicles out there that Clyde talked about. Life insurance, maybe life insurance may be something that you want to look at because it is over into that tax-free bucket. So there's a number of different things. Long-term care. What about that? Many of these life insurance policies now with long-term care built into them. So there's some nice advantages there. So just to let you know, we have you covered here. If you want to come in for one of our sessions, which Clyde will talk to you about in a minute, a strategy session, or if you want to just come in and talk about your Social Security and how we can help you, it all fits together, and we'd be more than happy to help you with that. Okay, Clyde?
All right. So thank you very much. Does anybody have any questions at this point?
I'm going to unmute everybody here. Okay, any questions from anybody? Okay, I guess not.
What we want to do then, I guess, is explain a little bit about how we work and the way it works. What we do is we have a personal strategy session. There's no obligation, no cost to you for that, where we would take a look at several things. We'd look at your tax return, your Social Security statements, your financial statements, your annuities, your life insurance. We go through all those things with you and fill out a fact finder based on our questions and all your statements and all these things. And then what we do is we put that through our software and we create a plan, a strategic plan over the next, could be 5 years, 8 years, depends on the situation, where we move money from those tax bucket 1 into tax bucket 3, which is to get you so you're tax free in retirement. And then we sit down and show you how that plan works, and we show you the difference. We show you the difference that you're going to have in your income from your existing plan to our plan. And we're going to show you our plan, and we're going to show you our plan if tax rates double. And it's always dramatic. I mean, we've never done one in all the years that we've been doing this where we didn't see a tremendous difference in terms of increased income, after-tax income in retirement, and much more dramatic increase in wealth left to your heirs. So it's really a striking thing when you see this plan. And then when you come back and you see the plan, there's also no cost or obligation at that meeting, or if we have subsequent meetings. We do not charge people to come to our meetings. We are a registered investment advisor company. We can charge our clients for advice, but we don't, because the institutions that we work with, the investment management companies, the insurance companies we work with, they pay us a commission or management fees on the investments. So we don't charge our clients at all. So none of this, there's no obligation at all on your part when you come to see us, or payment. So we'll all, if you're interested in coming in and seeing us, you can just get a hold of Art, and Art will show you his contact information, and you'll be able to come in and schedule an appointment. And by the way, because of the coronavirus, we're doing all those via Zoom meetings now. And we will be for the foreseeable future. And we can do everything that we do, we can do through a Zoom meeting. If you do want us to fulfill your plan, we use DocuSign. Everything is done over the internet these days. So we have clients all over the country that we've actually even never met with personally. So that's not any kind of an obstacle to working with us. We are with the Better Business Bureau in South Florida. We have an A+ rating with the Better Business Bureau. And I've been in this business now for 46 years, Art for over 30 years, Len for a long, long time. You know, we're all, you know, been around. So we'd love to help you if we can. Anytime you want to give us a call, ask any questions, set up a meeting, just contact us at you want to put your number up there, Art? And
yeah, well, it's on all the emails that I've sent out, but
okay, good.
Yeah,
good.
It's very simple. The email is art, A-R-T, at IWGadvisors.com.
Right.
And we'd be happy to work with you.
Yeah, and you're welcome to visit our website there, as it says right there, www.iwgadvisors.com. There's some excellent videos on there that you can watch and learn more about us, and then just contact us if you'd like us to do a strategy session for you. I think that's it. That's it.
Well, thank you. Thank you all for coming on. And we're going to be, actually, we're going to be doing these every 2 weeks now on Thursday, the second Thursday and the fourth Thursday of the month. So we'll be sending out notices ahead of time. So thanks for joining us. Have a great day.
Thank you, everyone.
Thank you.
Bye-bye.
Bye now.